Good evening, everyone. We are about to solve the question number 1 from March-June 2026 attempt. So let's start with the requirements. The number 1 requirement is prepare a report for the board of directors of P2 company, P company, which number 1 requirement evaluates the impact of hedging the payment to be made for the major project using future contracts. The evaluation should be supported by detailed calculation, including the number of contracts needed, the gain loss from the future contracts, and the treatment of the initial margin. Okay. So question number 1. Second part demonstrates and briefly explains how the mark-to-market process would work and calculates the balance on the margin account for day 1 and day 2 of the hedge. Third part estimates P company dividend capacity and any shortfall due to the investment to be made on the major project on 31st August 20x6. Then fourth is discuss whether using forward or over-the-counter option instead of future as suggested by some directors may reduce risk overall, increase cash flows for P company. So we have to compare the future with forwards and over-the-counter options. Then last is discuss how P company dividend policy should be managed, taking into account the comments made at the board of directors meeting. Professional marks will be awarded for the demonstration of skills in communication. Communication professional skill will only be tested in question number 1. It will not be tested in question number 2 and 3. Analysis and evaluation, skepticism and commercial acumen in your answer. So let's read all the exhibits. So this is number 1. P company is an established listed company involved in the manufacture of baby products with one overseas subsidiary company. P company has a stable shareholder base and its share price has performed in line with its main rival companies in recent years. P company board of directors recently agreed to invest in a major project overseas in the country of Vanuatu. The W pound is the currency. The board thinks that the project will generate a positive NPV value and lead to an increase in P company share price, and therefore it should be accepted. However, the board is concerned that this may affect the dividend paid by P company and how this might be viewed by the shareholders. Comments have been made by several directors in Exhibit 4. P company normally uses currency forward to hedge any foreign currency flows to minimize exchange rate risk. But this time, with respect to the funds required for the project, it is considering using currency future market to hedge the risk of currency fluctuations. This is mainly due to increased counterparty risk in the currency forward market. So because of the default risk, because of the counterparty risk, now this company has moved towards the future contracts. It is expected that major projects investment will cost 400 million W pound, and this will be paid in 3 months' time on 31st August. So technically today is 1st June. June, July, August. Today is 1st June. The following rates are available to Pittu company on 31st May. Technically today is 31st May, not 1st June, 31st May. Spot rate is available. September currency future, contract size is in dollar. Quotation per dollar, initial margin is 10,000 W pound, are trading at 3.22. P company hired the services of an economic specialist who advised that based on sound economic forecast, the spot and future exchange rate on 31st August can be estimated as follows. Spot rate. So closing spot rate is given. So in this question, closing spot rate is given. It is not like the previous questions. Closing spot rate is given. And September future rate 2.95. Board has decided to use these estimates to assess the impact of hedging on the risk of currency fluctuations. The board has heard that using future to hedge currency flows involve P company paying margin cost and may incur costs on a daily basis due to future being marked to market. We have done this in Daikin company. The board wants to know how these costs would impact P company based on the following daily price movement. Day one price is moved to this, day two price moved to this. Okay, we will do that. Tick size on each contract is 0.0001. The maintenance margin resulting in a margin call is 9750 per contract. Margin call will require P company to top up the margin account to the initial margin amount. It can be assumed that P company will keep the funds in the margin account until the period of the hedge ends, and the margin accounts funds will then be returned to the P company. Remember, margin account is kind of a deposit. You will deposit some amount to the other party. Okay. And once the future contract is over, then you will get your money back. How we are going to do this, we will discuss later. P company has maintained a stable dividend growth policy with dividends growing by a fixed annual rate over a number of years. It is expected that stable dividend growth rate will continue for the foreseeable future. This year, the board thinks there may be a shortfall in P company capacity to pay dividend for the year ending 31st August because of the funding required for the major project. Dividend declared and paid in the previous years are as follows. Number of shares are given, dividend paid are given. Number of equity shares in issue in 20x6 has not changed for the number of from the numbers in 20x5. For the year ending 31st August, following financial information has been provided by P company. P company sales revenue in the year to 31st August is expected to be 1500 million. In the previous year, it was 1415. In the year to 31st 20x6, company operating profit margin is 25%. Company expect to pay interest of 30 million, tax is 30%. It is estimated that P company has the following investment requirement in the year to 31st August. An investment equivalent to the amount of depreciation is required to keep its non-current asset base at present productive capacity. Depreciation charge for the year is 20 million. A 0.15 investment in additional non-current asset and $0.1 investment in additional working capital will be made at the end of financial year to 31st August. For every $1 rise in sales revenue. Okay. $10 million additional investment will be needed for other small projects. In addition to the above, P company overseas subsidiary company is due to pay dividend of 50% of its profit after tax. Subsidiary company expected profit before income tax is expected to be 55 million for the year ending 31st December before income tax. Subsidiary company pays tax at annual rate of 20% and a bilateral tax treaty exists between the countries where two companies are located. Therefore, tax is payable on profit made by the subsidiary company, but full credit is given for tax already paid. Remember, subsidiary has a tax of how much? 20%, but we have a tax rate of 30%. So we have to pay additional tax on that. Got it? %, 10%. I think 10% additional tax. Last part. At the meeting of a board, the following comments were made. So following comments were made. The board is concerned about the funds which need to be deposited into the margin account. Board is concerned that we have to deposit some amount in the margin accounts. Okay. And also the cost related to the mark-to-market process. The board has also learned that hedging using future contract result in basis risk. Okay, we know that. Given these concerns, some member of the board suggested that P company should either continue using forward or even use a over-the-counter option as alternative to the future to hedge the cost of investment. These directors concede that each derivative product type is subject to unique risk. Nevertheless, they suggested that using few forward or over-the-counter options as alternatives to future for hedging purposes may reduce risk overall and increase cash flow for the P company. We have to discuss on this. P company marketing director think that any project will result in a positive NPV should be accepted. The marketing director suggested that dividend should be reduced if necessary to fund project with positive NPV. He does not think reducing dividend for this reason would be seen negatively by the shareholder. We have to comment on this. P company finance director is of the opinion that it is necessary to undertake the major project. However, she is of the opinion that the stable dividend growth policy should be maintained as well. She thinks that asking the subsidiary company to pay additional dividend and using other cash reserve will be sufficient to cover any shortfall in the dividend capacity. However, her concern is that cash reserves are needed for other profitable projects and the subsidiary company management would not support paying additional dividend. Okay. If so, she suggested that P company should borrow any additional funds needed to invest in a major project and maintain a stable dividend growth policy. So you have to take a decision. Either give a stable dividend or reduce the dividend, use those funds to fund the project. P company CEO agrees that major projects should be accepted and also that a stable dividend growth policy needs to be maintained. However, he is concerned any increase in borrowing will breach the existing debt covenants. So it's a very good question, to be honest. Apparently, if you look at your first response that, oh, sir, it's a very difficult question, right? What was the first thought? Is it difficult or easy? Difficult or easy? Difficult, technical. Okay. Lengthy, I think lengthy is the best answer. Okay, let's start with the first one. Divide the 50 marks question into parts. Okay. Just imagine you have to fight with 10 people. And the good thing is all are not attacking at once. One will come, then other will come, then the third person will come, then the fourth person will come. At one time, you have to fight with one person. So it would be easy to manage in this way. Right? So just imagine only we have to solve this part. Okay, what is the question? Evaluate the impact of hedging the payment to be made for the major project using future contract. So future, we will do the future contract. Evaluation should be supported by detailed calculation. We will do that. Including number of contracts, we will calculate number of contracts. The gain loss from the future contract. Okay, gain loss. We never did that in recent past papers. Okay, and the treatment of initial margin. I know there was a lecture on initial margin, variation margin, but okay, I don't remember at this time. Okay, let's go into detail. Part A. Before that, it is appendix number 1. Appendix 1. Okay. Part A. And hedging. Impact of hedging. Hedging impact. Future contracts. So first step is payment, right? First step is payment. Transaction amount. Amount. Payment. What was it? W pound. So sign is not easy to found, then you can write pound. Otherwise, you can copy from the question as well. Okay. That was 400 million. Okay. What is the contract size? Dollars. Home currency is dollar, na? So we will buy W pound and we will sell dollars, right? Sell USD future contracts. September. September contracts. Exchange rate is W pound per dollar. Per dollar. 3.22. Got it? Number of contracts. Okay. Before that, let me write contract size. I think this is in pound. No, this is in dollars. So we will divide with this and then divide with this. Is that correct? 994. Please check, everyone. $994, right? This is okay. Okay. Normally, what is the next step? This is correct. Why 899? This is okay. What is the next step, by the way? In normal question, what is the next step? In normal question, what is the next step? Lock-in rate. But here, what we will do? Here, what we will do? In normal question, we always calculate lock-in rate because we don't know the closing spot rate. We don't know the closing future rate. Here, the closing future rate is given. This is more simple. Close the future position. Sell future. Buy future, right? What is the closing future rate? 2.95, right? Okay. Tell me it's a gain or loss? Gain. It's very simple. Gain. Right? Gain. You can calculate in absolute amount as well. Into 994 into 125,000. Right? So which currency is this? Can anyone guess which currency is this? You can calculate gain in dollars. How to calculate gain in dollars? Anyone? How to calculate gain in dollars? By dividing with, mashallah, you guys are doing wonderful. So what is the closing spot rate? Which spot rate we will use? 3.2. 3.2. Right? Okay. Don't final this. I think it is 3.2. 3.20. Closing spot. 3.22 is the current spot. 3.22 is the current spot. Closing spot is 3.2. But don't final this yet. Now let's move to the last step. Let's move to the last step. Actual payment, right? We will do actual payment at the closing spot, right? Which closing spot? 3.12. 3.12. So how do you know 3.12? 3.12 is the lower spot, right? Payment के लिए lower होता है. Remember, for payment we will use the lower one. 3.12. Right? Then gain in dollars. And then you will calculate the net impact. All right? But you can do one more thing. This is your payment, W pound. This is your gain. You can net the payment with the gain and then divide, then convert the amount in dollars. You can also do that. Answer will be a little different, but that will be okay. That will be exactly fine. So apart from margin, is everything clear? Apart from margin. Okay, now let's go to the question. How much we have to submit as a margin? Can you check how much we have to submit? How much we have to deposit as a margin? Initial margin is 10,000 W pound per contract. How many contracts we have done? How many contracts we have done? 994. Right? Guys, September future. Did I take the correct one? Yes. Okay. What is the spot rate? Spot rate is 3.56, 3.66. So we have to, which spot rate we will use? 3.56 or 3.66? Anyone? If you are depositing 10,000 W pound in an account, so you will buy that amount, right? So I will write here. Deposit initial margin. Okay. How many contracts? 994. How much I have to deposit? 10,000 W pound. Right? At what rate? 3.56. So this will be in dollars. I will deposit this amount. 2792. Right? And then you will get your money back on the last day, right? Deposit के पैसे वापस मिल जाते हैं ना. You will get your money back in the last date. What do you think, guys? You will get your money back on the last day. Agreed? Deposit is deposit. But there is one issue. On the last day, what is the rate in the market when you get your money back? Exchange rate has changed. It is a deposit. Why not we dividing it? No. Although it is a deposit, but we are buying from the market. Na? We are buying from the market. आप समझ रहे हो? We are buying from the market and then deposit. And now you will get your deposit back and you will sell. Let me write here. Impact of margin. Let me do in the working. Yes. Deposit is marked to market. Will adjust during the future trade. Yes. Margin. Margin, what we call it? Margin sell or margin balance at maturity. How many contracts? 994. How much you have deposited? 10,000 W pounds. Now you will get your money back. But now the exchange rate has moved to 3.2. You deposited this amount. You received this amount. Got it? बात समझ आ रही है, guys? So what is the impact? It's kind of a gain, na? Why we should divide with 3.12? What is the reason why we should divide with the 3.12? No. Why? You are getting your deposit back. So now you have to convert into dollars. We are selling in the market, na? Net payment. This should be the answer. Please check. Answer match कर रहा है? Is it matching with your answer? हाँ, rate is okay. Rate issue. There can be a rate issue. Don't take tension about the rate. By the way, examiner also has taken a different rate. I just checked the answer. Examiner used the 3.12 in the gain conversion of gain calculation. I don't know why. But this is okay. This is perfect answer. Don't copy. We can't copy the wrong answer, no? Because then it will change perspective in every question. This is correct. Margin, what is margin? Margin is when you enter into a future contract, you have to deposit some amount as a guarantee. Yeah, let me explain. When you enter into a future contract, you will deposit some amount as a guarantee. For example, you are taking admission with me, and I will say, okay, you have to deposit some amount as, for example, $10,000. Okay. So you are in Pakistan. So what you will do, for example, $1,000 आपने deposit करना है. You have to deposit $1,000 to Preproots. So you will go to the market, and market exchange rate is 280 rupees. You will buy $1,000 and you will send it to me and say, sir, I am depositing $1,000 for 3 months. How much cost you have incurred? At 280 rupees, 280,000 rupees, right? You have deposited $1,000 at a rate of 280 and you have incurred 280,000 rupees as a cost. Got it? Sahi hai? So after 3 months, I will give you your 1,000 back. मैं कहूंगा भाई, this is your money, take it back. But after 3 months, somehow exchange rate moved to 300. How much you will get? 300,000, right? So how much you will gain? Gain you wanna? This is your gain, right? 20,000. And if rate moves to 250, then it would be your loss. So यहाँ margin impact में क्या आया हमें? Kind of a benefit आया. It's a benefit. So margin impact is benefit. Because when we deposited, we incurred cost of 2.792 million. And when we are maturing that margin, we are getting back $3.106 million. It's a kind of benefit. Although this margin will change every day, but for the part of this calculation, overall we are getting the benefit. You got it? Acha ji, so one of the student asked question, if we use wrong rate in any of the step, we still get marks for the rest of the question? You will get, absolutely you will get marks in every step. And by the way, examiner has used only one rate, 3.12 in every calculation. 3.12. So don't worry about that. Okay, shall we move to the next part? So in all of these questions, we won't get the marks for the final answer. We'll get marks for the, yeah, obviously. Final answer किसका ठीक होता है? Where we use the lock-in rate, we will always use the lock-in rate because closing future is not given in the questions. Closing spot is not given in the question. I have seen this question like after 16 years where closing future is given. How to calculate under overhedge? There is no need to calculate under overhedge in this question because it was not asked here. If examiner asks, then you will do that. And how you will do that? Okay. Number one thing, if you are confused or kind of nervous about calculating under overhead, then I will suggest you take assumption that it's immaterial amount. So that's why it is being ignored here. Take this assumption and write this assumption. Okay, this is number one. But still, if you want to do that how to do that, let me guide this. So in this question, we are calculating answer in our home currency, right? Dollars. So, for example, so this, I will only show this just to explain the under overhead. Don't confuse it with the question, okay? Number one thing, whenever you are solving the question, always assume that you need to convert the answer into home currency. So how many contracts we have done? 994. What is the contract size? $125,000. And what is the exchange rate? Exchange rate is 3.22. But the problem is, if I multiply with this, I will get answer in WP. So what I will do, I will only multiply number of contracts into contract size. So I will get in home currency. So this is case of payment. And you will do the working on the other side in foreign currency. This is the working in other currency. That is WP. That is foreign currency. If you are paying this amount, 124.25 million, definitely you are receiving the foreign currency. Okay, how much? 994 contracts into what is the contract size? $125,000. Convert the dollars into WP by multiplying with the future rate, 3.22. We are receiving this amount because we will pay this amount to the foreign company. But how much actually we have to pay? Actually, we have to pay, I think, 400 million. So we are getting extra surplus payment, surplus amount. So what we will do? We will sell the surplus amount. ज़्यादा आ गई ना? We will sell the surplus amount at a forward rate. I am not linking with this question. I'm telling you generally in other questions. So then you will sell surplus, add forward rate. But अगर आपने इस question में करना होता, if you have to do in this question, closing spot is given. Then you will sell at closing spot. But generally we will sell at forward rate. So we will sell this, for example, forward rate is, I'm randomly taking 3.1. So you will sell that. That's how you will do the under hedging, over hedging. In lock-in rate, we have to multiply with the lock-in rate. Yes. Yes, we have to multiply with the lock-in rate. Okay. But this question was easy. Why? Because opening future was given, closing future was given. You just have to calculate the gain and loss. You just have to calculate the gain and loss. Then you will do the actual payment. Adjust the gain and adjust the margin impact. That's it. Okay. Question number 2. This is important. Demonstrate and briefly explain how the mark-to-market process would work and calculate the balance on the margin account for day one and day two. So before that, let's calculate the initial margin. I think we have already calculated that. Remember? How many contracts? 994. What is the initial margin of one contract? 10,000 WP. Initial margin. Okay. What is the maintenance margin which you have to maintain? 9750 per contract. 9750. Do you know what is maintenance margin, everyone? What is maintenance margin? Guys, what is maintenance margin? This should be the minimum amount which should be in the account. If your value falls down, you have to deposit additional amount, right? Okay, G. What is tick size? Tick size was 0.001. No, 01. 12.5. Day one. Opening future, which was our sell position. What we have taken the position? 3.22. 3.22. And this was WP over dollar. What is the rate on day one? 3.2230. Day one future rate. 3.2230. Is it a gain or loss? You have a sell position. Now market moves to this. Is this a gain or loss? By the way, it's very simple. You have a sell position at 3.22. Market moves to 3.2230. Loss. Now it is up to you whether you want to do in a tick way or direct way. This is WP over dollar into 994 into $125,000. Right? But we need in WP. How much it is? 0.030, na? WP over dollar. So $125,000. Yes. 375. 375. Per contract. Per contract. So total into 994. Total loss. Day one. Okay. So initial margin will falls to margin value. It falls below. So is there any margin call or not? For tick method, we have to divide with 0.0001. That will be 330 ticks into tick value then. So is there any margin call or not? Yes, there will be a margin call. You need to deposit additional amount. You need to deposit additional amount. Right? Okay. Now let's day 2. In day 2, you have to compare day 1 price with day 2 price. Day 1 future price. Remember, it's a sell, still sell. Day 2 price. Day 1 price is this. Day 2 price is 3.2219. ये रहेगा सेल ही. This is still a sell. It's a gain or loss. It's a gain. Let me do in a tick way. Na? This divided by 0.0001 ticks into 12.5. So 137.5 per contract into 994. Gain in WP. Margin account will move to this one. Right? There will be no margin call. Got it? There will be no margin call. The rule of this mark to market is you will compare current price with the day 1 price. Day 1 price with the day 2 price. Day 2 price with the day 3 price. And if you have decided to sell, so वो sell ही रहेगा. Day 1 sell with day 2. Day 2 sell with day 3. Day 3 sell with day 4. Okay. Now you can also explain this because examiner also ask for the explanation. But we can explain this in the, what we call it, in the report. Any question? All okay? Appendix number 3. Different capacity. Please ask. Sir, do we have to follow a report format? Obviously, we will make a report. We are just solving the numerical first. Na? Uh, Here we need to bring the deposit back to the initial margin. Here is the rule. In derivatives, we need to bring it to the initial margin. In stocks, we need to bring it back to the maintenance margin. So there's a difference between derivatives and stocks. But for the sake of what we call kind of याद रखने के लिए, to memorize this, we also always need to bring it back to the initial margin. But if you are above the maintenance margin, then you don't have to do anything. Then it is okay. Okay, we need to calculate our dividend capacity. What is dividend capacity? Can anyone tell me? In a very simple way, what is dividend capacity? In a very, very simple way, what is dividend capacity? Anyone? What is dividend capacity? Company ability to pay dividend. Okay. How much a company is capable to pay? Okay. The capacity of the company to pay dividend. Okay. Ability to pay. This is the English translation. Huh? What is dividend capacity? Numerical way. Tell me the numerical way. How we will calculate the dividend capacity? In a very simple way. In one word answer. I'm asking how to calculate dividend capacity. What should be your answer? How to calculate dividend capacity? Free cash to do equity. Yeah, very simple. Sir, free cash to do equity. Sir, if you forget everything, free cash to do equity. Okay, let's do that. So we will start from a profit of 20x6. Sales is 1500 and profit margin is 25%. $375. Interest is given 30 million. Profit before tax. Tax is 30%. Right? Anything else? An investment equivalent to the amount of depreciation is required to keep its non-current asset base at the present productive capacity. Okay, depreciation charge for the year is 20. Should we add this 20 million? Should we add this 20 million? Why? This is non-cash. We should add it back. Why we should not add it? Yeah, it is equivalent to the capex. Excellent. We will take the assumption. We'll take the assumption. Depreciation will not be added back as it is equivalent to capex. Okay. Next, additional investment. Uh, 0.15 investment in additional non-current asset, 0.10 in working capital for every $1 rise in sales. What is the previous year sale? 1415. Okay. Non-current asset, working capital. So we will take the change of sale 1415 minus 1500 into 0.15 into 0.10. Right? You can also add these two. Got it? Anything else? 10 million additional investment. Small project. 10 million. Anything else? Overseas subsidiary company is due to pay dividend of 50% of its profit after tax. Subsidiary company expected before income tax profit is 55 million. Company pays tax at a rate of 20%. 55 million. And subsidiary dividend. Company is earning 55 million. Tax is 20% and we will get 50% of that. Additional tax. 10%, right? Not on this. Not on this. On the gross amount. On the gross amount. Yeah, on 55. Excellent, excellent. I become always confused by depreciation less and add back here. So in free cash flow, we always less depreciation to calculate tax and then add it back. Yeah, in operating profit, depreciation is already deducted, na? In operating profit, depreciation is already deducted, right? And we should add it back, right? Got it? But technically, here we will not do that because capex and depreciation are same. Dividend cost. Right? Any question till now? Any question till now? So cash examiner can ask same question, capacity option, same in question of financial appraisal. Yes. Whenever there's a dividend capacity question like this, do we always have to calculate this? Obviously, yes. Exactly in this way. We have 3 to 4 questions. Explain additional tax whenever you are receiving income from your overseas party. Remember in investment appraisal, we have studied that we have to pay additional tax on that. But on the gross income earned, So gross income earned was 55. On that 55, we will pay 20% tax in subsidiary country. And then we will receive 50% of that here. So additional tax will be applicable on 55, not on the 22. Yeah, international investment vessel. Okay, this is our dividend capacity. Okay, now there is a catch. How much dividend shareholders are expecting? If you can calculate that. It was written somewhere. P company marketing director think that any project which result in a positive NPV should be accepted. The marketing director suggests that dividend should be reduced if necessary to fund project with positive NPV. He does not think reducing dividend for this reason would be acha. Okay. Dividend growth policy should be maintained as well. She thinks that asking the subsidiary company to pay additional dividends and using it was written somewhere. Yeah. P company has maintained a stable dividend growth policy with dividends growing by a fixed annual rate over a number of years. It is expected that stable dividend growth rate will continue for the foreseeable future. So we have to calculate what is the expected dividend. Two zero x2 20x3 20x4 20x5 shares 800 800 1000 1000 dividend paid 112 121 163.3 176.4 dividend per share. Okay. Dividend per share. So let's calculate the dividend growth. Because it is stated in the question that growth rate will maintain. Okay. Take the latest dividend, divide with the earliest dividend, raised to power 1/3. So growth is almost 8%. So expected dividend of 20x6 it should be like this, right? Total expected dividend into 1000 1000 shares here, na? So expected dividend is 190. We have a capacity of 226. Can we pay dividend? Can we pay dividend, guys? Because these are 3 years, na? Although it is 4 years, but base is year 1, na? So total 3 years. We have to check for the others. So what we call it? Major project cost. So what was the cost of the project? How much funds we required? 117 million. We need these funds. इसको million में convert कर लें. Let's convert this into million. We need 117.41. So is there any shortfall? We have 226, but we need 117 out of this, and we need to pay dividend 190.53. So what is shortfall? हमारे पास 226 है, but out of 226 we need to pay 117. But we still have to announce 190. So we have a shortfall of about 81 million. We have a shortfall of about 81 million. We have 226. But we also need to invest for the project 117. तो कितना हमारे पास shortfall है? कितना हमारे पास dividend है? We only have 109. But we need a dividend of 190. So technically we have a shortfall of 81 million. We have a shortfall of 81 million. So what we are going to do? We added 20 dividend 22 in the dividend capacity. 20, what is 22 is you have a subsidiary. It is given in here. No? You have a subsidiary. Subsidiary is earning 55 million before tax. You will deduct 20% from that, and you will receive 50% dividend from the subsidiary. So that is 2.2 million. I think 22 million, sorry. Okay. Okay, what is the last part? Discuss whether using forward or option instead of, okay, discuss how it should be managed taking into account the comments made at the, so now all are what we call it? Theory. So let's start the report. So let me, this is our report. Report to the board of directors of P2 company. What is this? P2? P double T. We will discuss every part now in the report. So I didn't solve part number 4 and 5 because we will discuss in the report. In the Excel, you only have to solve the numerical. So what is the first heading? Anyone? What should be the first heading? What should be the first heading? Introduction. And what should we write in the introduction? Anyone? That go through all the requirements that we will discuss all this. Hedging, mark to market, dividend capacity, forward and future, dividend policy should be managed. Okay. This report assesses the hedging impact using future contract for the payment of major overseas project. This report also covers the margin requirements, mark to market calculations, and its impact. It will also covers the other derivatives. This report includes the estimation of dividend capacity, shortfall in dividends, shortfall in dividend capacity, right? And how company has managed dividend and financing policy. Okay. It covers. It also covers. Everything should be in present tense. Right? Overview of all the parts. What should be the next heading? Then headings should be according to the parts. Impact of hedging. Should be supported by the real calculation. No. All should be part of the question. Number 1 is all part of the report. Look at the question. Look at the question. Requirements. Prepare a report for the board of directors of Pittu company, which. So then part 1, part 2, part 3, part 4. So all parts, part 5, all parts are part of report. Okay. Second heading. Valuation of hedging for overseas project. Right? This part has covered that P2 company manages the hedging using future contracts, and overall payment is now equivalent to $117 million. Appendix 1. What was the payment total? 117 something, right? 117.4 million. And overall, it's a gain, right? 0.4 million. The future derivatives has resulted in a gain of 10.5 million. Next one. Okay. There is also a gain of 304,000 314,116 on margin account by closing the margin account at maturity. Overall, future contracts has resulted in a favorable or beneficial position, whatever position for the P2 company. Right? And what else we have to explain here? The impact of and treatment of the initial margin. You have to explain a little bit. P2 company will deposit initial margin on 31st May 20x6 to initiate the contract, and it will be settled or mark to market on daily basis. Like in day one, margin balance falls below the maintenance margin, and P2 company has to deposit additional amount to bring the balance back to what we call it, initial margin. In day two, I think we have to, we will, I think this will be covered in later part. I think this is, we will write this for the next part, next heading. Here I should write this. Here I should write this just generally about the exchange rate. to start the future contracts, P2 company deposits the initial margin as security and it will get it back in future at closure of future contracts, right? Company P2 company will also face exchange rate movements on the initial margins. As today, it will be deposited and at contract closure, P2 company will get it back. These calculations are estimate and subject to basis risk and maintenance margin movement risk. Right? Although there is no counterparty risk in future contracts, however, future contracts is prone to other risk. You just have to explain. Second part is, then you have to write mark to market. Then next part is mark to market. And for mark to market, I think we have already explained enough. Mark to market variation. Okay, Pittu company will deposit initial and okay. In day two, there is gain overall, and there is no margin call, and P2 company does not have to deposit any amount as margin balance will increase overall. Increase to what was the margin balance? 10 point something million, right? What was that? $10.076 million. 10.076 million. So the P2 company will deposit initial margin. How much initial margin? You can also write this. 9.94 million. 9.94 million. Appendix 3. Like in day one, margin balance will fall to maintenance margin. You can also write the figures. Falls below the maintenance margin. How much it will fall? 9.57567. 9.5567 million. Right? I think this is enough. Yeah, we can write that amounts are based on estimates. Okay, what should be the third heading? Anyone? What should be the third heading? Dividend capacity? No, no. Dividend capacity is not the third heading. Look at the requirements now. Third is only estimate. Third heading is forward and over the counter. And for dividend capacity, we have to write in the last part. Other derivative options. Other derivative options. Then you have to write the other derivative options. Discuss whether using forward or over the counter option instead of future as suggested by some director may reduce risk overall and increase cash flows. So we have to explain what are the other derivatives and the impact on the risk and cash flows. This is the derivative. Point number 4, na? Forward and over the counter options. Some directors has suggested other derivatives like forward and over the counter options instead of futures to reduce risk and generate and to create positive impact on cash flows. So now you have to tell me what are the impact on the risk? Anyone? Now you have to compare the risk. What are the risk? So let me compare this. In future contracts, major risk is basis risk, and that is basis risk. Basis is the difference between spot rate and future rate. It is expected that this risk will diminish over the period and future rate will become equal to spot rate at maturity. However, if it may not happen, that risk is called basis risk. Future contracts also has margin requirements which makes the calculation difficult to predict, and it will create a risk for for cash flow or liquidity budgeting for company. Forward contract does not have any basis risk and what we call it, margin requirements. However, it has other risk like counterparty risk similar to over-the-counter options. However, this risk can be covered, can be minimized, can be mitigated if P2 company does the contract with high credit worthy financial institutions. Right? Right? And what else? In OTC option, P2 company has to pay premium in advance, and there is a possibility that other party may default if P2 company if P2 company able to get significant gain. Right, guys? So you have to just explain the theory. Yeah, forward also carries the risk of default. I have written that. Na? Counterparty risk is risk of default. Na? Now you have to tell the impact on the cash flows. Now you have to tell the impact on the cash flows. Cash flows impact. Future contracts has significant impact on cash flows movement. As company deposits initial margin and this needs to adjust on daily basis for mark to market calculations. So future contracts has an impact on cash flows. On the other hand, forward contracts does not require margin and there is no impact on cash flows except at maturity. And that can be a gain or loss for P2 company depending upon market conditions. For OTC option, P2 company has to pay premium and advance, and apart from that, there is no cash flow impact during contract, at maturity. There can be a possible impact if P2 company exercises the option or use the option. Uses the Got it? So it was quite simple. Acha, I can guarantee student will not understand the requirement. Marks are 8. Discuss whether using forward or over the counter option instead of future, as suggested by some directors, may reduce risk. You have to write about the risk. Increase cash flow. You have to write about the cash flow's impact. Okay. If you're not writing about risk and cash flow, so you will not get the marks. Got it? How we will get the marks in theory? Is it 1 marks per valid point? No, it depends. It doesn't mean that 1 mark for one valid point. It can be a 1 mark or 2 marks for a valid point. There were 3 requirements in the question, not 2. Forward option, impact on risk, impact on cash flows. What is forward option? Impact on risk, impact on cash flows. Right? Okay, gee. Last. Discuss how P company dividend policy should be managed, taking into account the comments made at the board of director meeting. So let's read the comments again. P company marketing director think that any project which result in a positive NPV should be accepted. Marketing director suggested that dividend should be reduced if necessary to fund project with positive NPV. He does not think reducing dividend for this reason would be seen negatively by the shareholders. You have to comment on this. He's of the opinion that stable dividend growth policy should be maintained. He thinks that asking the subsidiary company to pay additional dividend, I don't think so. Okay, 22 million more. However, her concern is that cash reserves are needed for other profitable projects and the subsidiary company management would not support any additional dividend. If so, she suggests that PE company should borrow. Okay, and CEO comments, CEO was okay on the major project should be accepted. Stable dividend policy should be maintained, but he was concerned about the covenants. Last part. Director's comment. Response to director's thoughts. जी guys. हाँ, additional dividend. नहीं, additional taxes we have already covered. Tax we have already covered. We have calculated tax on the total. जी, anyone, how we will do this? First of all, explain the situation. Yeah, we will, we do. First of all, explain the situation. Dividend capacity is 226 million and 20x 200x6 before investment and in major project. Appendix 4, I think, right? 4 or 3? 3. The expected dividend should be equal to 190 million. Appendix 3, according to stable dividend growth. And investment required for major project is 117.4 million, which results in a dividend shortfall of 81 million. Right? Now you have to write the comments. This is the situation. Now you have to read the comments of the directors and respond that. Different directors have suggested different points. Marketing director is suggesting, what marketing director was suggesting? Dividend should be reduced, suggesting that project should be accepted and dividend should be reduced to fund the positive NPV project. What is this policy, guys? Do you know what is this policy? What is this policy? If you have read, if you have studied the dividend policy, what is this policy, by the way? Accept the project, reduce the dividend, it will not impact the shareholder wealth. What is this policy? Anyone, what is this policy? Relevancy, irrelevancy, if you remember. Nah, this is not residual. ये relevancy है, irrelevancy. Relevancy, irrelevancy. irrelevance dividend policy. If you don't remember, don't worry, but write the overall concept. Write the overall concept. This is according to irrelevancy dividend theory where project where it does not matter whether dividend should be increased or decreased. If there is any positive NPV project and company is doing that by cutting the dividends, it will reduce the dividends, but it will increase the shareholder value. It will reduce the dividend, but it will increase the share prices as company is investing in positive project. However, it ignores that market is not perfect, and shareholders may find this news as negative because company is reducing the dividend level, right? Got it or not? To be honest, it's all story. So now you write about the finance director. Finance director and CEO are suggesting that company should accept the project and also maintain the stable dividend by borrowing from market or getting more dividend from subsidiary. Right? Explain the situation. No. Irregular dividend is nothing. Irregular dividend is something else. Irrelevancy policy is something else. Right? So number one suggestion. First suggestion is arrange funds internally from cash resources and by taking more dividends from subsidiary. But this will result in shortages of funds for investment in projects. Right? ये लिखा होता ना? This was the point, right? So if P2 company ask for more dividends from subsidiary, it will create pressure on subsidiary and it will be short of funds for reinvestments. Okay. Second suggestion is to arrange funds from external sources like borrow from market. Right? P2 company should consider whether additional borrowing is allowed under previous covenants, is additional borrowing still is additional borrowing allowed in according to the previous contract, is additional borrowing matches the gearing ratios required under covenants, right? What else? P2 company can also go for equity raising, but that can be expensive choice, as equity is expensive compared to debt. Anything else? Subsidy management did not agree to give manage because they have to invest the funds as well. If P2 company able to get additional debt at cheaper rate and manage to maintain the covenants, P2 should go for borrowing, except the project and should maintain the stable dividend policy, because I don't know what to suggest. I think the best way is we should do the new project and we should maintain the stable dividend policy because CEO is also biased towards that. So I think this is the best way we can write. Then you will write the conclusion. And after writing the conclusion, then you will write the report by and date. Okay. What should be the conclusion? Conclusion should be simple. Company should go for a future. However, if company does not want to have a cash flow variation, then company can go for the forward contracts only if company able to get it from the high credit worthy institutions. Then you will write again that company should fund the shortfall in dividend from the additional borrowing if it able to get at a cheaper rate and try to maintain the stable dividend policy. Yeah. This is also point. Positive NPV project can also increase the debt capacity of the company. Venture capital you can write, but in a very short form. In a very short form. So that's how you will do it. Above, it's a very lengthy report, introduction, part 1, part 2, part 3, part 4, and then conclusion. We will not mention the date. We will not mention the name. So guys, I have solved a complete question in front of you. Don't ड्रामेबाजियां बंद करो, खुद क्वेश्चन करना शुरू करो. This is the first report I have seen because you have not solved any 50 marks question. That's why this is the first report you have seen. It is same for every question. Lengthy तो होगा ना. This is okay. The first question. Okay, good. सही है ये. 197 ये कैसे हो गया? How this is 197? 241. Subsidiary dividend is already in dollars, man. But still you will get the marks. You will not get marks on this because you didn't write in a report format. Why should I comment on the theory when you have not written the report? Company should sell September future account because it needs to protect the dollar. Okay. You will get the marks on this. Theory is almost relevant, but you will lose a very good marks for professional skills. Although you have done a numerical in a very good way, there are mistakes, but it is irrelevant. For those mistakes, only hardly 2 to 3 marks will be deducted. But for theory, you have done in a very summarized way. I need a full report in a report. If covered in a theory format, you will get marks, but not very healthy or very good marks. Why? Because you have not written in a theory in a report format. Second, you have written in a very concise way. Yeah, yeah, you can also share again, guys. So, Asad sir, please take that lecture again. It's my humble request, where I've explained that when to buy and sell future. So normally when we write report, there is a line at the start of the question, landing page normally where they tell us our role. If they mention we are finance manager, so it should be incorporated. No, don't write anything at the end. Don't write anything, please. लेक्चर दोबारा नहीं आ जाएगी समझ इंशाल्लाह. वो lecture, take that lecture again where I was explaining this part. Take the screenshot of that lecture. Send me in the group again. Okay. And tell me the point where you are where you unable to get the concept. I will explain you. Don't worry. Tension na le aao. Okay, the next assignment. Okay. Okay, good. कोई marks नहीं मिलने इस conclusion के. You will not get marks on this. Why you have written report on a Excel? Okay, theory is okay by the way. Your theory is okay, but I'm not expecting theory on the Excel. लिखा सही है. And by the way, you know that in forward and option, what is your mistake? You have to tell the impact on the risk and the cash flows, right? So you didn't explain in that way, but still it is okay. You will get marks on the theory, but you will get proper marks if you wrote like in a proper format. This assignment is very good. The parts which you have solved, it's very good. I'm afraid if you have solved on your own, then it is fantastic. If you have taken the help from the question, then I will insist that don't take help from the answers. But if you didn't take the help, then it's a very fantastic assignment. Next is why you are solving the report on the Excel. Why? Now, I'm assuming this is a Word file, okay? This is okay. Deduct this as well, no? Didn't read that. 246, okay. 190 is okay. Shortfall is 60, it's more than 60. It was 80 something, no? This report evaluates the impact of hedging to be made for the. Good. Good. It's a very good report. Only issue is you have written on the Excel. Otherwise, it's very good. Excellent. Good. Good. So that's it. It was a comprehensive question, to be honest, and comparatively a challenging question compared to the past papers. Hopefully, in our exam, we will get easy question, a manageable question compared to this. Any question, guys?